Good evening, everyone. Hope you all are doing well. So, today we are going to discuss question number 2 of March June 21. The question which we are going to solve is bond group. In the previous lecture, we solved question number 3, Matty Company. And in today's lecture, we will solve question number 2, bond group. In this question, there are three subsidiaries of the bond group. The first subsidiary is Cameron Company, the second subsidiary is Dean Company, and the third subsidiary is Horner Company. If any student have this question from the Google, not from the ACCA CBE platform, because previously the question uploaded on the ACCA CBE platform was different than the questions which they just updated on the new CBE platform. So don't worry, the concept, the terminologies, the methodologies of solving the questions are same, which we have covered in the previous past paper questions. So nothing new in this question as well. This is just about the consolidation, about the parent subsidiary group cases. So this is day 2 of March June 21, question number 2, bond group. Let's start the video. It is 1st July 2005. You are an audit manager in James and Company. This is the audit firm, a firm of chartered certified accountants. Your role includes performing post-issuance audit quality reviews, and you are currently reviewing the audit of the bond group. The group, which had a financial year ended 31st January 2005, and in respect of which an unmodified audit opinion was issued last month. The group supplies computer components specializing in graphics card. You are reviewing the group audit file as well as the audit files for 3 of this group's subsidiaries. It means the group, bond group, and their subsidiaries are audited by us. All 3 of these subsidiaries are material to the group financial statements and have a financial year end of 31st January 2005, same as the group financial year end. Each subsidiary's audit opinion was also unmodified. The following exhibits available on the left-hand side of the screen provide information about the bond group and the points you have identified for each subsidiary in the group. Cameron Company, Dean Company, Horner Company. Let's read the requirement first. So we all know question number 2 and question number 3 covers 25 marks each. Out of 25 marks, 5 marks for the professional skills and remaining 20 for the answer. In relation to the matters described in Exhibit 1, 2, and 3, comment on the quality of the planning and performance of the group audit. Whenever there is a word quality, we all know this is from the block 2, ISQM1, ISQM2, or ISA 220 revised. Now, in this question, the examiner asks you to comment on the quality of the planning and performance. So, this is either 220 revised of the group audit and the audit of the components of the group, discussing the quality management and other professional issues raised in respect of Cameron, Dean, and Horner Company. Now, in this case, the examiner is not just asked you to comment on the quality of the performing and planning of the group audit, also the audit of the components of the group, discussing the quality management and other professional issues. So in total, the examiner asks you 4 things for each of the subsidiaries. Let's read the exhibit 1 for Cameron Company. Okay. So your firm audits all group companies with the exception of Cameron Company, a subsidiary which was acquired during the last financial year. So it means we are auditing all the subsidiaries except for this one, Cameron. Cameron Company was acquired by the group in April 2000 X4 and is audited by Carey Associates, a small local firm. Highlight this thing. Even in the question, the examiner mentioned that all the subsidiaries are material to the group. So it means these are the significant subsidiaries. And we all know if the significant subsidiary is audited by another auditor, such as component auditor, then we have to check the criteria of ICED. So these questions also cover the using the work of other topic as well. Look how your previous block lectures are integrated with these questions. Cameron Company also outsources its internal audit function to Carey Associates. Again, last topic of block 1. If an entity outsources its material function to the outsourcer. The section of the external audit working papers provided by Carey Associates and relevant to internal controls contains very little documentation other than a cross-reference to the files maintained by the internal audit team and a statement that we can rely on the internal controls as they were tested by our firm in May 2000 X4. This is a wrong statement. Every year and on every assignment, the external audit team should have to evaluate the entity's internal control system because there is a possibility that there are new updates on the systems and the previous systems are not working effectively. In respect of Carey Associates, the group audit working papers contain the following statement. Our firm can rely on the work of Carey Associates. As one of James and Company's audit partners left the firm to become an audit partner at Carey Associates, and he was involved with the audit of Cameron Company. Other than some background about Carey Associates, which had been printed off from the firm's website to provide background information, there is nothing else on file in relation to the firm. So it means there is lack of information about the integrity and screening of the Carey Associates. The group audit working papers also include a note relating to the consolidation of Cameron Company into the group financial statements. Cameron Company prepares its individual financial statements using local accounting rules, which is allowed under national regulation. It does not use IFRS accounting standard, which is applied by the rest of the group. It is a valid statement because the subsidiary is based in another jurisdiction and where they can use local accounting rules. But for the consolidation purpose, all the subsidiaries should follow IFRS as bond group following IFRS accounting standards. It does not use IFRS accounting standard, which is applied by the rest of the group. The group audit partner commented in the working paper that local accounting rules are very similar to IFRS accounting standards. This is a wrong judgment or a wrong statement by such an experienced person. Local accounting rules are very similar to IFRS accounting standards, so there is no need to perform any additional audit work in relation to the consolidation of Cameron Company due to it using different accounting policy to the rest of the group. So that's it for Exhibit 1. Now move to the answer slide. Okay, so this is bond group March June 21 past paper. This is question number 2. Important points. We all know question number 2 cover 25 marks. 5 for the professional, whereas 20 for the answer. Comment on the quality of the planning and performance of the audit group. If you want to watch the lecture on quality and ISA 220 revised, then you can watch block 2 lectures on ACCA YouTube channel. Give headings to each paragraph for securing professional marks. Now, I have mentioned the professional marks breakup on each past paper slides. So this is for your learning, for your reading. If any student skip this point, then examiner will also skip your marks. Okay. Now, bond group part A, Cameron Company, Carey Associates. Cameron Company was acquired by the group in April 2004 and is audited by Carey Associate. Just copy from the exhibit and paste. A small local firm. Cameron Company is a significant component of the bond group and should be audited by James and Company and any of its component auditor. Carey Associates, being a local audit firm, may result in a lack of independence, competence, and expertise. ICE, remember the criteria which affects the audit quality of Cameron Company. Further, James and Company should evaluate the independence, competence, and experience of the Carey Associates. How and when? Before obtaining the work performed by them. Cameron Company also outsourced its internal audit function to Carey Associates. Due to this, the independence of the Carey Associates is impaired as the external audit and internal audit are two different assignments or engagements. Internal audit is a responsibility of the management, which results in a management threat. We all know management threat is a significant threat which can't be reduced or mitigated by any safeguard. Self-review threat is created as Carey Associates might be reluctant to review or perform the work, as they also offer internal audit functions to the Cameron Company. Further, the external audit working papers provided by Carey Associates and relevant to internal controls contain very little documentation, means that sufficient and appropriate audit evidence has not been obtained by the Carey Associates in respect of Cameron Company. Also, the Carey Associates stated that we can rely on the internal controls as they were tested by our firm in May 2004 is incorrect. As per the auditor's responsibility, ISA 200, it is necessary to maintain professional skepticism throughout the audit and perform TOC even last year controls were operating effectively. Therefore, James and Company should request Carey Associates to perform further audit procedures and obtain sufficient and appropriate audit evidence. Now, in the one heading, I have explained so many things. You guys can also understand that this doesn't look nice. Now we are at the learning stage. We are not an expert. But again, we are not considering this format as an excellent or a good format. So, how do you expect that the examiner would like your format if you do the same? That's why I recommend you in all my lectures that please mention separate headings. In this question or in this part, you can write so many headings such as management threat from this to this, self-review threat from here to there, then sufficiency and appropriateness audit evidence, then prior year controls, reliance on the prior year controls. So how you have to make headings. Now, group working paper. The statement still we are solving the part A Cameron Company. The statement in group working papers that the firm can rely on the work of Carey Associates is incorrect because the work lacks sufficient and appropriate audit evidence. Further, professional skepticism and judgment are not there in the audit of Cameron Company by the Carey Associates. Reliance can only be made when the audit firm critically evaluates the competence, independence, again, ICE criteria Also, the partner of James and Company left the firm and became part of Carey Associates, lacks integrity, independence, as Carey Associates provides an internal audit function to the Cameron Company, and also results in a familiarity threat due to reliance on work. There is no information about the Carey associates on file, which further increases the doubt on the integrity and objectivity of the Carey associates. The requirement of the group working paper is of the audit supervisors, as they have to review before making an audit report or passing to the manager. So it results in a lack of competency of the supervisors, as they don't have pointed out this thing while reviewing the working papers. The audit working papers should be critically reviewed or evaluated by them when the audit teams performed their work. Further, this results in a lack of communication. Look, ISQM1 factor number 7. This results in a lack of communication between the audit seniors and the juniors. Now, local standards. For an individual financial statement, the local accounting standards is applicable which Cameron Company used. However, for the consolidation purpose, IFRS used by the group should be followed while making the group consolidated financial statement, and the subsidiary financial statements should be adjusted as per IFRS. Why? Because the parent, the bond group following IFRS. The statement by the audit engagement partner that local accounting rules are very similar to IFRS standard, there is no need to perform any additional audit work about the consolidation is incorrect and results in a lack of competence and doubt on the leadership skills. Like why the audit engagement partner is recommended this thing. Cameron Company's accounting policies should be aligned with the group policies for consolidation purposes. Now we all know whenever there is our evaluate, we have to give a conclusion. Now, in this case, in this question, we have to give conclusion after each part. Conclusion: based on the above mentioned factors, the overall quality of the audit work performed by the Carey Associates for Cameron Company is not sufficient and appropriate. Further, the audit working papers prepared by the group auditors shows a lack of independent competence and leadership skills by the engagement partner, and a lack of supervision and review by the audit supervisors. Therefore, the opinion should be revised after performing the additional work. So, my friends, this is how you have to write your answer. Your drafting should be clear, it should be concise to the point. No need to write judgment or assumptions based answer. Make sure your answer should be case specific. And the best thing to write your answer about the case specific is just to pick the point from the question and explain in your words. This is the only thing which you can do if you want to pass this exam in the first sitting. If you are not following this approach, then it's just a recommendation or an idea that you may or you will follow this approach in the second attempt. So it's better and a wise decision to follow all these techniques, tips, and suggestions in the first attempt. Now move to the exhibit number 2, which is Dean Company. Okay, so I think this is a small exhibit. Yeah, okay, perfect. Dean Company owns a small number of shares in Corden Company, amounting to a 2% shareholding. What do you think? Is Dean Company also a parent company of Corden Company? Can anyone tell me? No. 2% investment, 2% shareholding means it should be treated as per IFRS 9. It is an equity investment, a trade investment. The investment is accounted for as a financial asset at fair value through profit or loss as required by IFRS 9 financial instrument. Cotton companies shares are not traded in an active market. Oh, that's good. The examiner also give this thing. Remember IFRS 13 fair value measurement. And the value of the 68,000 which is recognized in Dean Company's financial statement is management's estimate of fair value based on an offer received for the shareholding in April 2004. The audit team checked the arithmetic of management computation but didn't obtain further audit evidence. This is wrong. Because according to the audit conclusion, the value of the shareholding is below the group materiality level. Small immaterial misstatements may become material when aggregate. Yes, there is a possibility that on individual basis they are immaterial, but once they are aggregated, they should be material as well. The latest financial statements of Cordon Company prepared to 31st Jan 2005 are included in the audit file to provide background information and show that the company has net assets of $550,000. Materiality for the group consolidated financial statements was determined to be 350,000. So yes, this amount is less than the materiality amount, but on the individual basis. Let's move to the answer slide and see how to write this answer. Okay, so this is part B, Dean Company arithmetic check. The audit team checked the arithmetic of management's computation but did not obtain further audit evidence. Because the value of the shareholding in Cordon Company by Dean is immaterial, which is incorrect, even if the amount is immaterial, as the shares of the Cordon Company are not traded in an active market, it means they have no active market, and as per IFRS 13, fair value is adjusted using the level 2 approach as there is a measurement uncertainty. Further, the fair value of investment of 68,000 recognized in the financial statement is based on a management estimate which might be incorrect. We all know this thing. The estimates involve subjectivity and judgment, which is not even audited by the audit team. Okay, students, can you tell me what if the examiner asks you the same questions, but of course the amount will be different? So, do you guys can write an answer? I want you to write in the comment section. The estimates involve subjectivity and judgment, which is not even audited by the audit team. The materiality of the group is based on overall group financials, whereas the materiality of the subsidiary is based on the subsidiary financials. Also, the audit conclusion indicates that the audit team was incompetent to perform the audit as the financial instrument is a high risky area that should be audited by the senior audit team. The senior audit team member should perform the work on the investment that Dean Company obtained in Cordon Company. Remember 2% investment to ensure that the investment is correctly recognized in the financial statement of Dean Company. The fair value of the financial assets is recognized at the acquisition date, which is an overstatement, as it should be recorded at the year end date after taking the change in P&L. We all know in case of fair value through P&L, all the changes are taken in P&L and transaction cost also expensed out. If you don't know, then you can watch the lectures on IFRS 9 financial instrument on my ACCA Passpoint channel. For your better clarity and understanding, I will give a link of IFRS 9 SBR complete playlist on this site. Further, the 2% shareholding value 68, which is greater than Cordon Company's net asset value 11200000. How to calculate this figure? 2% multiplied by 5,50,000 on 31st Jan 2005. If financial assets are overvalued, they should be overstated the profit but is not shown in the audit of deemed company. The amount of the financial asset is immaterial to the group materiality, but for the individual materiality level, it might be material. So the individual misstatement should be compared with the individual materiality level, which in this case is not appropriate, as the group compared this financial asset valuation with the overall group materiality. Due to this, the audit opinion might be unmodified. Okay, there is an important thing. Sometimes in the group questions, the examiner give you the overall materiality of the group. And when we are going to solve the exhibits of a subsidiary related issue, there is a possibility that the subsidiary misstatement amount may be immaterial. Why immaterial? Because the materiality amount given by the examiner is based on the overall group materiality. That materiality is for the overall group materiality. So, of course, we know in the group there are so many subsidiaries. So how is it possible? How the comparison should be like with like if we are going to compare the subsidiary A misstatement amount with the overall group materiality. So that's why I have explained in the start of this part, which is part B, that there is a possibility that this amount is incorrect. Why? Because the comparison is not with like. Okay, now we are left with part C, owner company. I am thinking that you guys should solve this part by your own because you are just left with few days in your exam. So if you are not practicing right now, then when will you start your practice, my friends? Time is running. Please be hurry. Make sure you guys are done with the lectures and now you are focusing on past paper lectures. If any student want a timetable, a schedule of the remaining days, then please comment down. I will contact you each one of you on an individual basis. So if you have any fear and any anxiety or any issue, you guys can comment down. Okay, let me read the part C or part 3 exhibit for you. Sorry. So this is exhibit number 3, owner company. I will give you an overview. It's a small exhibit. During the audit of owner company, the audit team became aware of a breach of data protection regulation. Highlight this thing, whereby an employee of the company had made its customer database available to a third party. Wow. This disclosure is in contravention of the regulation, non-compliance with laws and regulation. Remember, guys, please. The audit working papers refer briefly to this situation and conclude that it has little to do with the audit. Oh my God. As no one outside of the company is aware. Don't you think we are an auditor and we are not just responsible to the shareholders? If you watch the professional liability lecture, then there is a term liability in tort, general liability, responsibility of an auditor to work with due care and diligently because we are also accountable to the stakeholders, the users. No further investigations were made by the audit team, and the audit manager noted in the working papers that the matter does not need to be discussed any further with owner companies or the group management teams, as I have received assurance that the person responsible for the breach of regulation has been dismissed. So, guys, in this small exhibit, there are so many points. Let me show you on the answer slide. Look how many paragraphs I have written on this small exhibit. So this is how you should have to develop your answer. You should have to gear up your technical skills, your professional skills, your drafting skills. Your linking should be case specific if you want to achieve the passing marks, the professional marks. This exam is very, very easy if you guys have proper strategy and proper command, then you can pass this exam. Trust me, trust me. Okay, please guys try to solve part C. If any student face difficulty in today's lecture or in the previous lectures, then you are most welcome to contact me. Take care and goodbye.